George of the jungle, strong as he can be.
How do you get help with the closing costs or maybe even the down payment in a really tight competitive real estate market? That's what we're going to be discussing in thecreditjungle.com today. This is George Anderson. And, you know, despite coming into cold weather and fall and everything else in 2020, we're still seeing a very hot, very active real estate market. And unfortunately for most people, when they're looking at a first-time buyer priced home, which, boy, the good old days when it was $300,000 along the Wasatch Front, but we're going to use $300,000 just because it's even numbers here and it's a little bit more palatable for people who are watching this video and thinking about buying a home. But anyway, there's some minimum required investment for a down payment depending on whether it's a conventional or an FHA loan. Now, I've got a whole other series that I put together on 4 different no down payment programs, and there's some instructions on there on how to determine which one might be good for you. And of course, I'd be happy to talk to you. But for a lot of buyers to be competitive, they need to have to offer a full price or sometimes even above market price. And then that means that they're going to have to come up with their own closing costs. And so they're prepared for the down payment but not the closing costs. And so the common question is George, can I add my closing costs back into the loan? So let's use a $300,000 purchase price example here. FHA requires 3.5% down. So that would be $10,500 down to what we would have as a base loan of $289,500. So if we look at the option here for raising the adding to the loan, well, what are we in a sense doing? Well, if the closing costs are going to be $6,000, we're going to say that closing costs are roughly 2% of the purchase price. Obviously, on a $500,000 home, they're less than that. On a $100,000 home, they're going to be more than that. So I'm just using this as kind of a target range with our price here. But if I added $6,000 to my loan amount here, and I end up having a loan amount that ends up being $295,500, if the sales price is still $300,000, do I have 3.5% down? No, I've got more like 1.5% down. So this would not meet the minimum required investment. Okay, so this is the MRI, not in the medical terms, but in the mortgage term. I probably ought to do a video on mortgage acronyms one of these days. But that minimum required investment has not been met. This loan will not be eligible to be sold to FHA. So how do you make this work? Well, there's a couple of other options on here, and the most common one that we try to get, but again, competitive market, the challenge is, well, how about adding it to the sales price? So if we did that, and the closing costs are $6,000, could we offer the seller $306,000 and have the $3,000 or the $6,000 paid in closing costs? That way, yes, the seller would end up still getting their $300,000, but now our sales price is $306,000. So what happens there? Well, we still have a 3.5% minimum required down payment. So now we've got 3.5% down on the additional $6,000, which is $95, something like that. Anyway, let's just call it $100. So it's going to add about $100 to the down payment. But the buyer's like, yeah, I can come up with $100. I just can't come up with the $6,000. Now this works great until what? We have to have an appraisal on the property. Well, if this home was listed at $295,000, went under contract at $300,000, and then we added $6,000 to cover closing costs, that appraisal may not hit $306,000. And if it doesn't hit $306,000, well, then we got some issues here. And they go, but wait, and the real estate agents, they get together and they go, hey, I know how to make this work. Let's have the lender pay the closing costs. And so there, for a long time, there was always an option of doing what we would call lender paid, okay, where there would be an option there where the lender, now how does the lender pay the closing costs? I mean, do I have a magic wand? Well, in essence, kind of yes, because you can do, let's just say that the going rate was 3%. Back in the old days, before we had this stratified pricing that we've had crazy, that's been for the whole year this year. But prior to that, we used to be able to bump the interest rate about 0.5%, and in exchange for that 0.5%, we could get about 2% in credits from the bank that we were selling the loan to, because they were willing to pay a premium to purchase a loan that yielded them a higher interest rate. Makes sense. But the problem right now is that if you wanted to get 2% back, well, you can't raise the interest rate. There's not an interest rate that you can raise it to that would pay a 2% credit. It's not out there. Roughly, you're looking at maybe for a 0.5% on the rate, you might maybe get a 1% credit on it, but you're just not going to make it happen all the way. So this is I don't want to say that this is not an option. Let's just call this a limited option to be able to help out with this. So the buyer's best friend in a situation like this is going in if they know that they're going to be in a competitive price range. If they know that they're going to be looking at a home that comes up that's a good home, the buyer's best friend is to have some cash. And we've got other videos that we've talked about on what are eligible sources for the down payment. So this is something that's kind of good to have figured out before you get out there and start writing offers. And it's a competitive market right now, and despite all of the economic winners and losers and everything out there, September had one of the highest purchase price numbers ever, and that was a recent statistic from the Realtor Association on that. And that just means that there's a lot of people out there that are still figuring out ways to do this. They're coming up with money, they're qualifying for the loans, and with interest rates as low as they are, that payment is really not that expensive. Even though they're paying a little bit more for the house, they're still getting a great payment because of the low interest rates here. So hopefully this explains a little bit of how this works. And just to add in here too, can the seller pay the down payment? Well, no, because it'd be like buying a home with $300,000 and I'm going to put $100,000 down, but I'm going to have the seller pay the down payment. Well, the seller is then selling the house for $200,000, not $300,000. There were some programs back in the 90s up until about the mortgage apocalypse of 2007 where you could have down payment assistance going through a third party where the seller would pay a third party, the third party would pay the down payment after taking a fee. Those programs all went away, probably for good reason. But anyway, here's how we typically have to structure a deal. Here's what works, here's what can work sometimes, and then here is what doesn't work. So hopefully that helps you. Thank you for coming into the creditjungle.com today. This is George Anderson. Push button, get mortgage professional, and I'd love to talk with you about your situation. Have a great day.